If you have an LOI in front of you for your pest control company, the most important number is not the purchase price. It's what you actually keep after taxes, fees, structure, debt, holdbacks, earnouts, and rolled equity. And the dangerous part is that some of the decisions that determine that number become much harder or impossible to change the moment you sign. At least that's the perception. Over the last 24 months, my clients have exited over $600 million in combined business value. And after 17 years on Wall Street as a CFA and CPA, I can tell you this: the founders who preserve the most wealth are not the ones who negotiate the highest headline price. They're the ones who get the right people involved before they lose leverage. So before you sign that LOI or immediately after, there are 3 calls you need to make. All right, this is very self-serving, but true. A family office wealth advisor who specializes in exits, not corporate executives, not stock options, and not a generic financial advisor, this is the first call you need to make. Someone who can manage your family office and the intersection of tax strategy, trust and estate planning, and investments. There's a huge difference between a salesman who poses as a financial advisor and actually someone who can think in a multidisciplinary fashion to engineer the best outcome of your sale. It could be someone that actually understands the industry in which you operate, knows the buyers, knows the moving parts of a private equity transaction, who can actually have the strategies that have been deployed time and time again in order to engineer the best after-tax outcome for your business sale. You don't need a tax preparer at this stage. You need more of a tax strategist that also understands investments. So people come to me in all phases of a transaction. Some come to me 2 years before, some come to me after the LOI, and lo and behold, some come to me even after the transaction closes. I had a situation a couple years ago where someone came to me late in the year after an $85 million transaction had already closed. And he thought he was totally screwed. And if he would have come to me before the LOI or even during the due diligence process, we could have saved him a ton of money. But because of the way this transaction was structured, with a holdback and an earnout payment in the following year, as well as rolled equity that is likely to pay out in the next 2 to 3 years, those provided very interesting tax planning opportunities where we could cut taxes on those components of the deal, even though the LOI had been signed, and lo and behold, the transaction had even closed. So in this $85 million transaction, there was a $5 million holdback, which normally would have been a $1 million plus capital gains tax payment. But because of our investment tax strategies that take advantage of tax loss harvesting, we were just able to save him over $1 million. And here's the way it works. We were able to deploy a portion of that $5 million into an advanced tax loss harvesting strategy. So the tax loss harvesting strategy was able to capture the returns of the public stock markets, just US public stocks, but also generate these tax assets through capital loss harvesting. They were able to generate enough capital losses to offset a $5 million holdback. And these are a tax strategy and investment account that's held directly in the client's name within Charles Schwab, with the tax losses delivered on a 1099 that not only goes to the client, but actually directly to the IRS. So the second call to make is an M&A advisor. If you don't have an M&A advisor already, you should call one. It's not too late to actually back out of the deal if you've totally screwed up the negotiation and you sold for a valuation that was far too low. You need an industry specialist who actually knows the multiples that people are paying for these businesses. They know the buyers and they know the terms. Sure, this person is going to have a huge incentive to talk you out of the deal and sign with them instead so they can bring you back out to market. But I think that's the type of information that you need in order to make sure that you have this devil's advocate perspective and you didn't sign a deal at a valuation that was too low at terms that could change. Oftentimes, the LOI is the starting point for a buyer, especially for a seller who doesn't have an M&A advisor. What typically happens in due diligence in this situation is that the buyer will inevitably find something that they supposedly didn't know about, and they'll come back to you without representation and they'll start retrading. Oh, we didn't know that you had this customer concentration, so we're not going to offer you $20 million. We're going to bring the valuation down to $18 million. oh, we didn't know that you operate in these geographic areas. So instead of $18 million, we're now going to pay you $16 million, and so on and so on. So making that call to an industry expert M&A advisor is a key person to think about the transaction. So the third person that you need to call is an M&A attorney. And I'm not talking about your local business attorney. I'm not talking about your buddy's buddy. I'm talking about a real M&A attorney that's done hundreds of deals. And if you can find an industry specialist, that's even better. They know the structure. They actually know the buyer's tendencies, because you have these big private equity backed companies that are doing deal after deal after deal. And an industry specialist M&A attorney, they've done deals with those buyers, so they know how to protect you from ultimately getting screwed on deal terms, which inevitably can hit your bank account, because they know how to ensure that you actually get your holdback, you get your earnout, and that your rolled equity isn't structured with preferential terms for the buyer at the expense of you. The good ones, I would say, also know how to collaborate with your wealth strategist and your trust and attorney to make sure the deal gets structured that provides the best outcome for you and your family. This is how I think of this process visually. Most wealth strategists or wealth advisors, they think once the LOI is signed, the game is over and you can't do any tax strategies. That's wrong. You still have this window between the LOI and when the deal closes in order to have a huge impact on your after-tax wealth from the transaction. I will say though, and this visually depicts it, is that as time passes from the LOI to the deal, the window does start to narrow and close when the deal closes. Sure, we have opportunities after the deal closes, as I mentioned earlier, but ultimately, you need to act as fast as possible after the LOI is signed. And look, it's a hectic period. When you're selling your business, due diligence is all consuming, and you're actually still trying to run your business, so it's important to act as fast as possible. So this same $85 million business sale that I mentioned earlier, they made several mistakes. The first is that they had no tax strategy or no wealth advisor quarterbacking the process. They had a trust attorney, they had a CPA, but those are typically backward-looking people and just focused on compliance and understanding what tax they're going to need to pay. They had no one involved in tax strategy pre-LOI or during the LOI process. To make matters worse, it was actually at the end of the year. Anyone who knows anything about tax planning, investments, etc., they know the end of the year is the absolute worst time to sell a business. Let's imagine you sell a business, and this one was in November. You have essentially 5.5 months, April the following year, in order to pay the taxes. If you sell a business in January, you have essentially 16 months. You have the entire calendar year and another 3.5 months in the following year. Not only can you execute tax loss harvesting during that year in which you sell the business, but actually you can invest the money and earn a return on the proceeds that will be earmarked for the tax bill later. So in this situation, this client just had no strategy, no guidance, despite the fact that his brother-in-law was actually a financial advisor, but not someone who was actually focused on business owners that are going through a big liquidity event. Luckily, and we talked about this earlier, he did have multiple aspects to the deal where tax planning was possible in the holdback, the earnout, and also rolled equity in a few years. But the big mistake that was ultimately made is not thinking about the structure and not thinking about the tax planning well ahead of the sale, and certainly after the LOI and before the close. And if you're actively selling your company right now and you want help reducing avoidable tax drag, protecting more of the proceeds, and building an investment plan so the money can support you for the rest of your life and grow, click the link below to book a call with my team. We'll look at where you are in the sales process, what decisions still need to be made, and whether we're the right fit to help.